All right, hey guys, what's going on? Back here with another Wolf Whale collab video, looking at Bitcoin today. And obviously, you'd probably know better than me because we've been looking at the charts all morning here and we've been discussing it. There's been a breakdown on Bitcoin, and so that's what me and you have been talking about. What personally I've been talking about since November. I think you've been talking about it in the same region. And,
yeah, we've been talking about it. We've been talking about it for months. So we've been talking about it since 60k. Like, it's nothing new. We've been keeping you guys informed every step of the way. So if you guys are long-term followers, you'd know exactly what we're talking about. But we'll let Wolf take it away with his daily chart to start with, and we'll dive into the 3-day. I think you're going to talk about the yield curve or the bond yields or something else today as well.
Bond yields, interest rates, yeah.
Yeah, I'll talk a little bit more about the DXY and the risk assets, and I want to talk about the 3-day and the weekly as well. So Wolf, I'll let you take it away off the daily.
Cool. All right. So, look, again, if you've watched the channel, if you watch either of our channels, you know a lot about the daily already, but just covering it once again, what we have on the daily, what we had at least, what's playing out currently, is a bear flag formation. If you don't believe it's a bear flag, it's at least an ascending channel. However, we see it as a bear flag formation. Now, there's a few ways you could measure it as a bear flag formation. I think that's the important part, because a lot of people are thinking, well, if it's a bear flag formation, you'd have to take it from 69k, apply it all the way down to the bottom of the formation there, and then apply that measured move. And you'd say that, well, do you guys seriously think we're going to 14k or 12k or somewhere in that region? To that, I think we both collectively say, not necessarily. I think that's that's the absolute worst case scenario. I don't see Bitcoin going below that point, and I actually don't see Bitcoin going to that point at this point in time. I think we're in agreement here, and I think you'll look into it a bit more later, that we're going to the 200-week SMA. That's probably the most likely scenario, and that's going to be at about 24k by the time we get there. So I don't necessarily believe that that measured move is the right way to measure it. However, that is the worst case scenario. I would personally suggest that the measured move from this bear flag formation should be taken from December. And you'd apply that from the top of the December move to the bottom of the channel formation, and then you'd apply that one to the breakout point, and you can see that that's actually targeting, coincidentally or not, around 24k as well, which is where I think we're going, right? I don't think we're going to get to 24k in May. With that said, that's what the measured move suggests. I don't think it's going to happen in May, but what I would say is that dates are always pretty hit or miss in terms of technical analysis. What you're really looking at is the price action and the price rather than the dates. Dates are a little bit as I said, hit or miss. You can guess all you want, but they're not very accurate. So 24k is what we're looking at, and I just want to differentiate again. A lot of people would be like, well, wasn't this like an accumulation period? When at the bottom of a downwards trend you start going upwards. Well, I think that's an easy trap to fall into, especially for some people who might not have that much experience in TA, and some people who might be listening to perhaps the wrong people in the space. An accumulation period is what we saw basically in May to July, where you see, and you might say, well, how's that an accumulation? We were going down, we were going, lower lows, lower highs. Well, essentially what you can see is it was actually a descending channel formation, and we had descending volume at the same time, which means the lower we went, the less people were willing to sell, essentially. So it's a slow shift of power from the bears to the bulls, right, in that period. And this is the exact opposite of what we saw there. We had descending volume and the price was rising. So as I said, back then it was the bears to the bulls. Now it's the bulls to the bears, right? So now we're actually going to be dropping downwards. And I think that, again, me and Whale are in agreement here that the first target for this downward moves, because that's a clear breakdown, the first target for this downward move is going to be this dotted yellow uptrending line. And that's going to take us to around somewhere in the 37k region. And yes, obviously this isn't a confirmed support line as of yet, because there's only been 2 tests. Technically you need 3 tests to confirm support line, but that's just speculation, right? I would say 37k is the next move. So the daily chart's really straightforward. And another thing is, as well, is like, if we want to flip this back bullish, if we want to label this a fake out, I don't think it's likely, but it certainly could happen. If this wants to be labeled a fake out, what we need to do is obviously jump back within the channel, but we also need to be taking 42k. And a little bit above it as well. Why is that? Because 42k is not only, as you can see here, this red line, a major kind of horizontal resistance that's been spanning all across since January 2021, but it's also a major dynamic resistance zone, as you can see by, for example, Ikamoku Cloud, the bull market support bands in that region, the Gaussian channel center line, You could probably look at something like the 20 SMA, which is the Bollinger Band center line as well, the 75 SMA. The point is there's lots of resistance in that region. And so for now, for the time being, the daily chart is basically concluding the move downwards is going to take us to 37K. Invalidation for that move downwards is going to be a break above 42K. That's all I've got to say about the daily chart there.
Yeah, I totally agree with everything you say. I would say, just to extend on the points you made there, two things I would like to just extend on is, I would say we'd need to see 42 to 42.5 personally.
Yeah.
And as sort of a bull flag, bear flag situation, I would personally lean towards, like I've been saying on my channel, I'm leaning it towards more of an ascending channel just because of the duration of this consolidation. Anything greater than about 2 to 3 weeks is usually more or less likely to be an ascending channel, whereas these bull and bear flags, they only require 5 touches, 2 on the top, 3 on the bottom. This has had multiple, so I leaned a little bit more towards the ascending channel. And you're probably wondering, does this make a difference in regards, because at the end of the day, it doesn't really matter what the consolidation terminology is. We're more worried about the price point or the price direction or where the price is going to end up. Does it make a difference if we call it a bull flag or a bear flag or a ascending channel or a descending channel? Not really. The measured moves are going to be the same. So the terminology is kind of irrelevant, but the price direction that we mentioned is what you kind of have to be focusing a bit more on. Okay,
I'm going to regardless.
Go on, sorry.
Yeah, I'd just like to say, regardless, I'd actually agree with that as well. I think that on my channel, I've marketed it more as an ascending channel because it's kind of like an easier pill to swallow. Because people, as I said, people don't like thinking that the measured move should be from 69K all the way down here and then we're going to 12K. So descending channel is definitely the better way to look at this for sure. Anyway, I'll let you go ahead.
Yeah, so just to touch up on that, that's kind of what my price points are. And I do want to just mention, again, me and you have been telling people for months about this, and we're not just going to change our opinion. For us to get macro bullish again, we need to reach and break this 200-day moving average on the daily chart. All right, and by breaking, we mean a daily close above that level. Cool, we're going to move on to the 3-day chart. I got a lot to talk about, guys. We're first and foremost actually going to touch up on that the 7-day chart, sorry, and talk about that 24K price target. You've probably heard both of us speak about a lot. Then we're going to go back and talk about the rest of the stuff. So how did we originally come to a 24 price tag target? We actually came to that, how long ago was that, Wolf? Like 3 months ago or something?
24K. Well, I was first talking about that target at around 63K, so whenever that was, but I think I finally consolidated that view at 58. So somewhere in November, early December. Yeah,
so I was talking about the exact 24K target. I kind of brought up with you in our first live stream video. I showed you this method I used to predict it, which was the rise or run of the 200-day moving average and the distance between the current price, the trajectory, and our target. My target was initially the 18th to 14th of July 2022, when I believe the price will hit around 24K. So what I did is I take the distance between the 200-day moving average and that price target in the date. I apply it to the current 200-day moving average to kind of get the trajectory or the distance we're kind of moving over a specific period of time. And all I do then is I copy and paste that difference back over, applying it to a 200-day moving average and drawing somewhat of a straight line across and upwards, and that's kind of our target here. So we see that lines up with exactly 24,000. It's kind of how we came to our $24,000 price target. It's not just a random number, and it's not even based off a horizontal support or resistance. So we're going to go back to the 3-day chart, because a lot has happened on the 3-day chart that we want to mention. And first and foremost, we have actually closed a 3-day candle below the 200-day moving average. This is a very significant sell signal, and probably coupling that with the loss of the ascending channel, we have one of the strongest sell signals for the Bitcoin chart that we've had in close to 2 years. All right, I'm not trying to scare anyone here, but that's the objective facts, the objective reality of the data, what it's telling us. And we're going to show you what we mean. We're going to come back and talk about the RSI. So for now, we're just going to be focusing on these red lines. So the red lines in our charts. Our first break of the 200-day moving average, well, should I say 2 years ago, on the 7th of March 2020, we had that drop down below the 200-day moving average over here. And we ended up losing from that break around 45%. And now I know a lot of people are saying, well, this was a black swan event. You can't go off this. But in reality, guys, as I've mentioned before, the trigger to what the price breaks down, so what causes the price to break down or break up, yes, it's relevant, but it's kind of irrelevant in the same sense that when these major levels of support or resistance break, the price will gain strength in the opposite direction. So regardless of whether it was a black swan event, that COVID causes crash, or the price naturally drop below this level, we were bound to see a significant pullback or crash when we lost this 200-day moving average. We saw the same thing happen back over here, guys. So the 9th of November 2018, a 50% drop after losing that 200-day moving average. Those are the only two instances we have on this chart, on a 3-day chart, of losing the 200-day moving average. But if we go ahead and look at the RSI, key point on RSI is green lines, the 34.34 on RSI. Every single time we've lost, or the RSI drops below this level, we see a significant crash. We saw it happen on the 16th of January 2022, not too long ago. We saw a 25% drop. We saw it happen on the 10th of May 2021. We saw a 40% drop. We can see the RSI. Again, the RSI did lose the instances of 34.34 on both cases of the 200-day moving average crosses. And even going further back, we saw two other instances in 2014, well, sorry, 3 instances in 2014, where we had a 47% drop, a 48% drop, and a further 41% drop. And moving all the way back to 2011, we saw a 52% drop. Every single time we have lost the 34.34 on RSI on the 3-day chart, we see a significant crash for Bitcoin. Now this begs the question, we are not even near the 34.34 on the RSI yet we have lost the 200-day moving average. So what is that telling us? It's telling us one of two things. First and foremost, this lower price target of 12K might be possible because we have a lot more room to move downwards between obviously where we are now, the 200-day moving average, and 24K, and as well as that 34.34 on the RSI. It's kind of hard to predict exactly. That's why I think Wolf did mention that, you know, we are making you guys aware of this extreme bottom, which is like 12 to 14K, but we're not saying it's going to happen just quite yet. We're just more or less making you aware of the possibility, making you guys making you guys know that it is a possibility, but we're not putting our, you know, we're not going to chuck all our money on it. We're not betting on it. We're definitely not thinking it's going to happen. Our primary target is that 24K still. Did you have anything to add to there, Wolf? Are you happy with that, or?
Yeah, I'm happy with that. And what I'd like to say, I think this ties into my personal analysis a bit as well. I think I'll share my screen. Are you done on this chart?
Yep, you can go ahead and share. I'll chuck it back over to you.
Yeah, I'll share my screen because I think that you, correct me if I'm wrong, you're kind of leaning towards a July bottom on Bitcoin.
Well, according to my data, what it says the 14th of July, that will be the earliest time we reach 24K.
Yep, correct.
So any time after that point, we would have reached that target, but the 14th of July, now, like I said, I haven't edited this data since like November. I've kept this same analysis since November and it's held very, very, very true. The 14th, if you go watch our first live stream way back in like December, you would know the 14th of July, that's what I said, is my expected initial bottom. So anytime after then, it should hit the bottom.
Okay, so that's interesting, right? So I have a few charts that I've been looking at recently that have suggested quite clearly that, you know, in my opinion, there's going to be a May crash. And I think that May crash, it's basically May, right? On a macro time frame, 6 days until May is basically May. So I think that a May crash is already starting to happen. I'm just going to keep calling it that. And that's interesting because this kind of lines up a bit more with that July prediction. Now, as you guys would know, I don't know if many of your followers would know, but I know my followers certainly know. I have said for quite a while that I think the most likely bottom of Bitcoin is going to be between November and December. And I have said as well, given that there isn't really too much data to go off when predicting the date range, what I'm interested in is the price. So I've said November to December, but recently I have been considering, since there's going to be, in my opinion, a May crash, which I'll look into right now, that July bottom might even be certainly a possibility. So firstly, just 3-day chart. I know you talked about it, but I like to talk about it just a bit more. So obviously dropping below the 200 on the 3-day chart, 200 SMA on the 3-day chart is very important. And you know, as he said, we've seen that now. So we've closed the candle below that. That's, as he said, a major sell signal. I'd also like to note the fact that, you know, like he said as well, we usually see like a 40 to 50% correction when we lose that. And that's interesting because what I've kind of correlated that to is a cross between the 50 and the 200, but I suppose they kind of happen at the same time, don't they? Because when the 50 and the 200 cross, generally, especially in 2018, we see that correction, but we've also got the COVID droppers data. So generally, you know, that's evidence for a May crash because it's already playing out. We've closed below the 200, so that's a May crash coming on there. And then we've also got another chart here that I've identified recently that's suggesting the same thing, right? A May crash. This is the weekly chart. We have the 75 SMA in blue, the 50 in red, and the 200 in green. What you'll notice is that when the 50 crosses under the 75, we're generally in the midst of a major correction or at the bottom of that correction on two separate occasions, right? So two occasions, it's not very many occasions, but given the other data, I think it's compelling. And these things will be crossing in about 2 weeks. So that's another piece of evidence there suggesting a May crash, which we're currently seeing, right? And then if we delete all this and delete all this stuff here and bring up the Gaussian channel, for example, which MegaWhale's talked about a lot in the past, you'll notice that when this flips red, and it's only done it on two separate occasions, we're like on the verge of seeing that, what I've said, that May crash. And so, given the fact that when this, again, May crash happens, we generally see like a 50 to 40% drop very fast, like within probably two or 3 months, even less. That would suggest, if that's playing out right now, that, and again, this Gaussian channel is going to flip red very soon, that we will be bottoming much sooner than November to December, like I've been saying previously. And that kind of leads me to believe, and this is just speculation here, that potentially, even that ultra bearish scenario of 12 to 14K, the 4-year cycle theory might actually be pointing to that happening in November to December and 24K happening in like July, right? That's just speculation there, but I thought I'd bring it up. I think it's pretty interesting. But regardless, totally all of the information that I'm looking at here, especially on the longer term charts, and even on the daily, is pointing towards that 24K region. Whether it be July, whether it be November to December, whatever, it's probably going to happen anytime in the second half of this year. And I think what you said is totally correct. We are seeing the biggest sell signal on Bitcoin since the COVID crash. And since 2018, etc., is definitely a major event. Well, that's not an exaggeration at all. So I'll let you jump into some other charts. But did you have anything to add on that topic?
No, not really. I would like to just kind of point out that you say May crash, and of course your data suggests that is 100% possibility. But just going back in history, looking at May is quite a neutral month for Bitcoin.
For sure.
So you're right. We have a possibility for either crashing here or seeing a significant rally. The data is massively leaning towards the downside, but just to point out, guys, TA is not always 100% accurate. There is always a chance we can rise here, but the chance currently, specifically since we lost that daily 3-day candle over that 200-day moving average, it has dwindled hugely. There's like a 95% chance now we continue downwards. And all the data we've shown you today is supporting that direction. And I'd just like to say for the new viewers here, myself and Wolves, we're not bullish, we're not bearish, we're not bulls, we're not bears. We genuinely actually don't care where the price goes. I would much prefer the price to rise, as Wolf probably have said many times. We make a lot more money, our followers increase, everything for us goes better when the price goes up. But the reality is we're always going to tell you guys the facts and the objective truth. The fact of the matter is the price has been in a downtrend for quite some time now. We've been telling you guys that, and we do believe it's going to continue downwards as well. So we will be the first people to tell you it's bullish when it is bullish, just like we were in July. But we're not going to be jumping on that bullish bandwagon just for clout. We're gonna stick true and make sure you guys get the best analysis and most honest analysis we can provide. So
sure. And I'd like to add one more point too. Now, again, you brought up a major concern in the crypto community. I know it's not really a massive concern of your own, but generally a lot of people, I get many comments about it. They say, and I bring up the May crash, quite often recently, and they would say, well, how can we see a May crash? Because May is I think it's the most bullish month for Bitcoin historically, or one of the most bullish months for Bitcoin historically.
It is November, October. They're generally the most bullish. Then it's about April, May. So it's up there. It's definitely more favorable towards the bullish side than the bearish side.
Correct. Yeah. So I would encourage people to kind of understand that, although that data is interesting, it might just be a coincidence. Because if at least there are things that stray from that. Like last November was meant to be the most bullish month ever, whatever. We crashed down 32%. That's very bearish, obviously. But what I would encourage people to be considering here is that when I'm referring to a May crash, I'm not saying that because all Mays. I'm saying that generally after the bull market, the May after the bull market is generally very bearish. That's not kind of saying. Anyway. I'm not even referring to previous Mays. I'm referring to this May specifically due to technical indicators that are specific to this day range. But 100%. I thought I'd just say that.
Cool. I think what we'll do next is I'm just going to briefly touch on how you should be acting right now in this current price action, what you should be waiting to see for, like what triggers we need to find. And then after that, I want to talk about the DXY, I want to talk about the stocks, I want to talk about interest rates and all that jazz. Sorry, I've got an alert going off. Forgive me for that one. But let's move over back to this chart. So I got a lot of people asking, it's awesome finding out about where we're going to go, but like, what should I do now? And this is kind of what we're going to answer now. So first and foremost, guys, while we're ranging in this zone here, wrong button. While we're ranging in this zone here, all right, we are very much bearish. You should be not looking to buy absolutely anything. All right, you should not be buying anything. In fact, you should be de-risking yourself this entire time. When should you be considering to be slightly bullish again or looking for a short-term scalp? Well, we would need to break the 100-day moving average on the daily chart, and we would actually, in fact, need to close a daily candle above that. We have seen a huge rejection from that point here. We didn't quite get above 42 to 42.5k. We got rejected, and thus we didn't really have that entry signal. But if we can get a daily candle close above 42.5k, we will most likely push up into this range here. All right, so we're looking for that daily close above that level there to push a little swing high. Of course, breaking the 200-day moving average on the daily chart is where we need to go before we can be proper bullish. So while we're between wherever we are now and below this 200-day moving average, we should not be considering any long-term positions. You shouldn't be accumulating, you shouldn't be stacking, you shouldn't be doing any of that stuff. Accumulation and stacking is when the price is bottomed out. All right, we haven't bottomed out. We're still in the midst of a crash. We're still in a downtrend. We haven't hit accumulation. We haven't hit long-term demand. Right now, the only thing you should be doing is taking small scalps on coins that have good risk-reward ratios with a very small percentage of your portfolio. That is it. No long-term holds, no long-term buys. If you're long-term buying now, what you're basically saying is, I expect the price to bottom here and the price to continue upwards from here. And all the data suggests otherwise. So you're making that assumption based off your emotions and based on what you think is going to happen, based on what you want to happen, rather than what the data is suggesting. And if you're taking a look at the data and you're looking at on-chain analysis as a reason to justify your decisions, you have to remember, for every time it's correct, it's wrong 2,000 times. It's just the reality of it. You can interpret that data however you want to interpret to fit any narrative you want. Just like the media, they twist stories. On-chain data is the same. It can be twisted and adjusted to fit any narrative. The fact of the matter is, technical indicators, the math, the data, the chart shows us, can't be adjusted to our own interpretation. We can only adjust our interpretation to it. So it's your job as an investor, as someone on social media, someone looking for guidance, is to vet out and find people who are actually telling the truth rather than using the data to manipulate their side of the story and push their emotions onto you. All right. So, and obviously Wolf completely agrees with everything I just said. So moving to the DXY, I want to talk a little bit about this. This may be confusing to a lot of you, but if you want a more detailed example or explanation of what I'm about to say, I highly recommend you go to my channel and watch this video here, how rising interest rates will affect Bitcoin and other risk assets. We're going to talk about it today, but I did about a 20-minute video talking about it. But first and foremost, you may notice that the DXY is upwards, and it broke out of a 21-year-long trend. What does that mean for the market? What does that mean for crypto? What does that mean for the global economy? That is what we're going to discuss. First and foremost, for those of you who do not know the DXY, and I know a lot of these viewers are going to be from Wolf's channel, and Wolf has told you guys what the DXY is, but essentially it is showing the strength of the US dollar or cash in relation to assets. All right, that's a very simple explanation of what it is. So moving up over here, what have we got? And I'm just going to fit it back in the screen over here. So we're going to start with the lender. Now the lender over here lends money to the borrower, and the borrower in this case, we're going to talk from the US government standpoint. A lot of viewers here probably from Australia or different countries, but the US is kind of the global economic power, so we're talking from the state of the US government. They borrow money from lenders, all right, accumulate debt, all right, so they accumulate debt in the process, all right, and this principal loan here is their debt, all right, so lender borrows money, accumulates debt, all right. With the debt, all right, they obviously have to repay that debt. So you have your principal payments, which is made by a taxpayer. So in this period, so whatever money you pay in taxes towards the government this year, a proportion of that money goes off to pay the debt. All right, but you have to also keep in mind your money pays off future debt interest. So as debt accumulates over time, it also accumulates interest. Interest is determined on the interest rates. We'll come back to that in a second. It's very complicated, but basically the interest that is accumulated from the principal of the loan that the government took, you have to repay that as well. So this process is called funding economic growth through debt. All right, it's a very common process. It's widely used across many governments in many countries, especially in first world countries. It is one of the predominant methods of economic growth we see, which is funding economic growth through debt. All right, the problem is right now is the interest rates are rising massively. So what happens is the government now prints this money and they send that printed money back to the lender to give the lender their money back and make their, the debt zero. They now owe no money to the lender, but that debt is still there in circulation. So what does the printed money do? Increasing supply increases inflation because it decreases purchasing power at the same time, all right? So there's more money in supply, therefore the dollar is worth less, therefore it decreases buying power. All right, so as a result, interest rates rise. As a result of interest rates rise, interest on debt rises. When interest on debt rises, you have less cash flow available because more of that cash flow is going off to pay the interest. So now more of your taxpayer money from the current period and the next period is paying off the interest on that debt because interest rates are rising. We're seeing that happen right now. What happens when cash flow decreases? Well, you have a cost of goods. Cost of goods start increasing. Household expenditure increases. Cost of fuel, cost of food, everything starts increasing because the demand and supply balance shifts. And this is where it gets really interesting specifically for us. When we're talking about cryptocurrency, we're talking about assets. How does all of this that we just outlined impact the value of risk assets? Risk assets, what are they? Cryptocurrency, stocks, bonds, indices, all right? I would actually go as far to say the housing market is some sort of risk asset, all right? And what happens is when interest rates rise, I think it's first to explain this is not from a consumer or a retail perspective, all right? Market moves don't happen from retail, they happen from institutions, all right? They happen from government institutions. So this perspective is from company, governments, insurance companies, all these bigger corporations. They accumulate when interest rates are low, they purchase risk assets with debt. All right, so when interest rates, and they have been historically low, and I know Wolf is going to bring up that chart in just a moment, but interest rates have been historically low. Companies accumulate a lot of risk assets on debt when interest rates are low. So most of their purchases are on debt. Now the debt to equity ratios are very favorable because the interest rates are very low. But what happens when interest rates start to rise? They have to pay more interest, so their cash flow decreases. What happens when their cash flow decreases? The debt to equity ratio decreases. It makes their stocks, it makes their company weaker because their company's value is based on future cash flow or future cash flow earnings. When their future cash flow decreases due to the fact they're paying more cash into this interest, their company value decreases. All right. So what do they do to compensate? Well, they start to sell these risk assets. They sell their houses. Remember, a lot of places like Australia, companies, insurance companies can purchase residential properties, all right, which is ridiculous in my opinion. But they start to sell these houses. They start to sell their cryptocurrency. They start to sell their stocks, all right? They're increasing their cash flow to make their cash flow statements increase, to make their companies look more favorable. And in turn, what does that do? Well, it increases the DXY. The DXY is a representation. Everything we explained above, the DXY is a representation of. We see the DXY rising. Why are we seeing the DX rise? Because cash is increasing. People are putting their money into cash. They're taking their money out of these assets, all right? And as long as this is rising, it has a negative or a negative correlation with Bitcoin because Bitcoin is a risk asset. So when we see this rise, we see Bitcoin fall. And that is exactly what we just explained in the little demonstration above. Does that make sense, Wolf? You happy with that explanation?
Oh, for sure, dude. Yeah, 100%.
So I guess going from that, what does this tell us about the future? We can use the past to predict the future. We can use this math. We can use this economic knowledge to predict what's going to happen. And Wolf is going to talk a little bit more about interest rates in a second. But just to go and kind of like put something in before he does, if interest rates continue to rise, which they will, and Wolf will explain, we're going to see what we're seeing currently continue. And if we see what we're going to see currently continue, we're going to see the risk assets of our economy continue to bleed. All right, continue to bleed. So everything we talked about from a technical standpoint so far, the technicals of the chart suggesting downwards, we have actual economic evidence to support our theories. This isn't just like, all right, this bit of math says this. And we are market technicians at the end of the day. We base all our decisions on data and based on math. But in this instance, we actually have economic, I would say, backing or economic proof that our hypothesis of the downward direction is supported by the state of the global economy. And I think it's really important that when you're making long-term investments, you consider the state of the global economy, because most assets, when the economy is on a bull run or rises, will rise in value. All right. And just like that, when the economy is downward or in a period of downturn, they will decrease in value. So
yes,
purchasing long-term assets now, regardless of whether it's a house, cryptocurrency, stocks, as long as this economy is bleeding, as long as interest rates are rising, it would be an absolutely stupid idea. I can't say it any other way. It is a stupid idea. Your best bet now is to accumulate cash, trade on the side to accumulate cash, hedge against the market, and then you have this money available to take advantage of the low when it does come. All right, Wolf, I'm going to pass it on to you.
Sure thing. Yeah, I'll share my screen here. So yeah, I suppose a lot of people would kind of be a bit upset about that, including, well, I mean, inevitably everyone, right? Because in a way, there's no real safe haven other than cash, which, as you know, crypto advocates, we kind of dislike inherently, because, well, it's not good, right? But essentially, yeah, you can't really hide anywhere. You can't hide in real estate. You have to hide in cash. You're kind of forced to. You can trade. That's one thing, but for people who don't know how to trade, you're kind of stuffed, right? And you just got to take your best of the worst options. And I think that one thing we got to talk about as well is the argument to be made that, well, what if Bitcoin doesn't follow the rest of the financial markets down? What if Bitcoin doesn't follow the government down? What if Bitcoin doesn't follow interest rates, right? That's 100% something you can consider. However, I think in investing, and this is something I say quite a bit, although we don't truly know what Bitcoin's going to do, we have a pretty good indication. And the fact that, for example, that stock market candle, that S&P 500 candle the other day, just a few days ago, caused Bitcoin to actually drop below this channel, is a pretty good indication that Bitcoin, as of right now at least, is still very much correlated, towards those financial markets that are inevitably going to drop down further due to interest rate hikes.
Can I just jump in there, Wolf? Sorry.
Yeah, sure.
Sorry about that. I just want to actually touch on that. Was something I want to mention. A lot of people say what you just said, which is the stock markets cause Bitcoin to drop. I would actually argue that they're not correlated in the sense that just because SPX drop, Bitcoin drops. I would argue it goes back to exactly what I was talking about before in that diagram, is that companies reduce their exposure of assets at the same time over different assets. So as they're reducing their exposure in stocks, they also reduce their exposure in crypto, and thus they both drop at the same time. That's my point.
I agree with that. I think the thing is, though, the fact is the correlation is still there, right? So if the S&P drops, Bitcoin drops, it's the same basket. So to say that Bitcoin's going to break away and move upwards while the rest goes down, it's like, well, we're simply not seeing that happen yet. So why, I think another one thing in investing is invest with the trend, and the trend is they're both going down together. So although it is possible that Bitcoin could, go the other way due to the actions of these institutions and companies, it's not likely because it's not happening. That's all investing is. You have to base off the current data. And so, yeah, we haven't seen that before. Don't predict something that hasn't happened yet. Be aware of it and react when it does happen. That's what I would say personally.
Well put.
So I think that when it comes to interest rates, as you would have just explained extensively, obviously interest rates go up, essentially bad. Okay, bad for financial markets, bad for every asset you have, bad for yourself, bad for how much money you have, how much money you're spending, and so we don't want them to go up more as investors, essentially. But obviously they're going up. And Jerome Powell's recently come out and said that they're probably going to be going up by 50 basis points. Now, the next interest rates decision, the next FMOC meeting, is in about 10 or 11 days, on the 5th of May. So, what are we expecting? Well, by default, we'd be expecting, in my opinion, a 50 basis point hike, if not a 25 basis point hike maybe. But the point is, where are they going long term? And I think one of the ways we can get a speculative prediction about this is understanding bond yields. Now, bond yields historically on a surface level, when they go up, it's essentially the market and generally, the government, kind of foreshadowing those interest rate hikes. And so when bond yields return to levels we've previously seen, we can look at those levels and look at the time in which we saw those levels and look at the interest rates as that time and make a prediction as to where interest rates are heading. Because obviously bond yields go up whenever they want on any given day of the week, Monday to Friday, but interest rates can only rise whenever the Fed holds that FMOC meeting. So interest rates in a way are kind of lagging behind what the market is predicting via the bond yields. Very kind of difficult to explain and understand, but the point is, if bond yields go up, interest rates are expected to go up. And bond yields have returned to price points we've seen on both June 2019 and March 2018. So all we need to do is look at where we were in interest rates in those periods of time. Again, it's speculative, but it is worth looking at. So June 2019 was at 2.5% interest rates, and March 2018 was at around 1.7%. So essentially, the market is predicting at this point, or the market is behaving in a way that it would behave if interest rates were at 1.7% to 2.5%, which means that we're, interest rates in a way are critically undervalued at this point in time. Interest rates need to go up a massive amount more. And obviously the more these bond yields, start hiking, and this is only one bond yield, right? This is the 1 year bond yield, but it's a good example at least. The more they go up, the higher we can expect interest rates to go up. So essentially, as of right now, we're at a 0.5% interest rate. The market is kind of acting in a way it would act if we were at 1.7% to 2.5%. So what's that saying? It's essentially saying that interest rates are going to go up a lot more, which means that markets are going to go down a lot more. That's all it is. So,
yeah, no, 100% agree. And just so people are more aware, a bond, in the sense of bond yield, essentially, like Wolf said, rising interest rates cause bond prices to fall, and you don't want to get the bond price mixed up with the yield, because when the bond price falls, the yield increases.
Yep.
So I was talking about this, well, I guess we were talking about this before we filmed this today, which is essentially we've seen these yields increase massively. And if we look at the mathematical equation for what calculates this, it's essentially, if I just talk it out by showing us, current yield equals annual coupon payment divided by bond price. So what we're currently seeing is we're seeing a little bit, I would say, discrepancy in that formula, and we have to relate that to the fact that interest rates haven't risen and the fact that bond yields are rising based off the assumption that people think interest rates will rise. Thus, they will rise. So it is like what Wolf said, it is genuinely just lagging. It is inevitable that they're going to rise, and they will rise a lot. Wolf, did you want to take this time to talk about Crypto Academy?
Sure thing, yeah, I'll share my screen and show you guys the website. So Crypto Academy is launching. Let me show you guys the website here. Crypto Academy, Become a Trader, a 10-unit course, is launching on May the 16th. So, just over 3 weeks, just under 3 weeks. And essentially what we've created here, myself and MegaWhale, both of us have collaboratively created a trading course, 10-unit trading course called Become a Trader, in which it will basically take you from any level of trading experience to a better level of trading experience, to a more competent level of trading experience. We cover everything from, as you can see in the units here, market patterns, indicators, candlesticks, also market psychology, how to have a profitable mindset, cryptocurrency concepts, so even for absolute beginners, like what is Bitcoin, what is fiat, what are the differences, etc. Risk management, how to find trends, literally everything you can think of, to a pretty extensive level, right? To a level of which you'd expect from a professionally made course. And what we're seeing, what we've kind of put together is 300 to 400 slides, about 80 to 90 videos, 8 worksheets, a trading diary, very extensive amount of information, very in-depth amount of information, but also, very importantly, no rambling, right? We're not just going on and milking the time here. Every single piece of information, every single sentence in this course is necessary every single unit is necessary. All of them together work out to make a very competent trader, right? And so if you want to contact us about that, we have currently a pre-order style. Obviously, I just said the course information actually releases on May 16th, but you can pre-order for a much lower price than you would if you were buying on May 16th. And you can contact us about the price, about the unit information more extensively, any questions you might have, at cryptoacademycourses@gmail.com, and we'll reply to you promptly there. So excited to see some emails from you guys, excited to see some interest, and learning how to trade is one of those things, especially relating it back to the current market environment. Trading is kind of one of the safe havens right now. There's not really anywhere you can hide. You can't hide in real estate. You can't hide in long-term positions. You've got to learn how to trade. And so if you're interested in that, go ahead and contact us at, like I just said, cryptoacademycourses@gmail.com.
Well put, well put. Just to touch on that, guys, this course is not an easy course. All right, this course is a very, very detailed course, but we've condensed it into a, I would say, consumable and digestible amount of content. Some of the topics that we cover in this course, particularly the methodologies of finding trades and advanced risk management, require a little bit of learning and a little bit of attention. It does require some heavy amount of mathematics, but like we said, this course is all you need to become a trader. It literally has everything from teaching you guys what things are, explaining the importance, but more or less building on all of that throughout the 10 units to show you how to find trades for yourself, how to execute trades yourself at a high level, what to be looking out for. It literally it shows you everything we know and everything we can give you in 10 weeks. All right, so you know how to contact us, get around it, and do you reckon we end the video there? We got anything else to say?
I think we're all good. I think that the main topics of this video that we looked at was the fact that the macro situation's not very good, and it's probably going to get worse. And Bitcoin's just printed one of the biggest sell signals we've seen in years.
Absolutely. And if you're following this video through my channel, remember, head over to Wolves of Crypto on YouTube. Go ahead, subscribe. I know he's nearly at 6,000 followers. Are you at 6,000 now? You're just about 6,000.
6K, yeah, just 6K, yeah.
Just 6K. So go ahead and check him out and give him a subscribe. And of course, if you're watching from my channel, click that subscribe button and we'll catch you in the next video.
Yeah, same thing for MegaWhale. Go ahead and check him out, guys. He needs all the support he can get because he's a good analyst for sure, and we share a lot of the same opinions. We also disagree on some things. That's okay as well. We work together quite closely. Go ahead and check him out. I know that a lot of people on my channel don't like the Moon Boy, influencers or analysts, whatever you call them. He's definitely not one of those. So check him out. Cheers, guys.